In this video, I'm going to be talking about SoFi and the wheel strategy. We have a very interesting opportunity right now because SoFi is pulling down. We have some volatility in the market. My SoFi position right here, I have 3,100 shares, but I want to acquire more shares of SoFi because I believe we are selling it for a discount. The market is undervaluing SoFi. And I specifically want to cover the wheel strategy and how I would be using it. Real quick, the wheel strategy is essentially a system. It's a process for getting into high quality companies. You should definitely want to own the stock. And the wheel strategy is a simple method for collecting premium. Very simple. Sell puts to get in. Once you're assigned, sell covered calls to generate income. Once you're assigned, rinse and repeat. Okay. So I want to show you right now how I would do this for SoFi stock. The first thing I'm going to do is go to trade SoFi options. Again, the most important part of the wheel strategy is we want to own the stock. Okay. So when we sell a put option, you can't second guess yourself. You have to be pretty confident that this is a stock that you want to own, because when you sell a put option, you are basically saying, I will acquire this stock at this strike price. Okay, so I'm going to go to sell put option and I'm going to go for 30 days out roughly. Okay, 35 days in this expiration, December 19. I personally love traditional expirations. Traditional expirations are the third Friday of every single month. Now, I sell options on the third Friday because they have the most volume of traders and the most liquidity. So the third Friday is the best. Now, this expiry right here is going to be roughly 1 month out. And as you can see here, the premiums for SoFi are really nice. So I'm going to expand the $26 put option here. You can see the implied volatility is 76. This is what's known as high implied volatility. High implied volatility happens when the market is uncertain. Investors saying that, hey, we don't know if the stock market is going to go up or down. Therefore, we are going to price options more expensive because more can happen. We need to be compensated for the risk that we are taking, which is actually a good thing if you're an option seller. Higher volatility makes higher premium. Higher premium makes you make more money. You make bicep over tricep money. So I'm going to go for selling the $26 put right here. And essentially, market is going to open up in a few minutes, but I'm going to execute this trade. And then I'm going to do nothing. I'm going to wait until the option expires. There's very low management with the wheel strategy. The benefit of the wheel strategy is it's a fantastic retirement strategy for investors to utilize on a monthly basis. That means once you sell a put option, you don't have to do anything since you like the stock that you're selling a put option on. So you don't need any crazy techniques. You just need to sell an out of the money option with a delta that's around 30. Notice how I didn't even know we're at 30 delta. 30 is about my sweet spot. It can be 35, it can be a little bit less than 30, it can be 20.
For those that don't know, delta is a Greek letter that basically option traders use to measure how much an option's price will move for every dollar that the stock moves. So an option with a 30 delta on the trading platform will say, 0.3, and that means that SoFi will move 30 cents for every dollar that SoFi moves. So the option will be moving by 30 cents. This also technically means that there is about a 30% chance that a 30 delta option will go into the money by expiration. So if there's a 30% chance of it going into the money, that means there's a 70% chance that it won't go into the money. So you have a 70% chance of winning and a 30% chance of losing. And the 30% chance of losing is a good thing because you get assigned. So you see how this is such an amazing strategy where it's basically difficult to lose. You basically can't lose.
Just understand that out of the money options are profitable because you save money versus buying the stock. Because an out of the money option, if you get assigned, is cheaper than buying the stock today. So would you rather buy SoFi at $27 or would you rather buy SoFi at $26? Obviously $26. But how about this? You actually get paid premium $149, which is a pretty nice return. I'm going to put it up on the screen right here. For 1 month of waiting to get assigned and get a discount. Amazing, amazing stuff.
Here's a quick example. If you were to be selling a put option on a stock that is essentially 105 and you sold the, a put option at 100. Essentially, when you sell a put option that's below the current price of the stock or the market price, well, you're getting a discount, right? So imagine a stock that's at 105 and you sell 100 put, then you get a $5 discount. Same thing with SoFi, what we're doing now.
So when you sell a put option, you are getting the premium. And once you have the premium, right, you're good. That's in your account. You can go spend that on some food, some vacations, or whatever you want to spend your money on, and you just wait, just hang out, okay? Here, the volume is very, very high. SoFi is a very popular stock for good reason. Good implied volatility, solid business. I talk about SoFi very often on this channel, but the wheel strategy, man, it's undefeated on SoFi. If you want to make all sorts and all kinds of money, really take yourself to the next level, SoFi, good company, and selling out of the money puts is going to be very hugely advantageous. The bid ask is also just amazing. The tighter the bid ask, the better, because there's less slippage cost, okay? When there's a big, wide bid ask spread, you're losing money, okay? To execute on a trade, you're going to be right at the midpoint. That's why the mark here is 151. You know, it's somewhere in between, right? The bigger that gap is, the more money you're missing. So step one of the wheel strategy, sell a put option and wait, because you like the stock. Either two things happen, three things really. It goes up, okay, that's fine. You just made money on the premium, it expires, you do it again. SoFi slightly goes down, but it doesn't hit 26. That's great. That's like the ideal scenario, because everyone out there in the world is losing money on SoFi or whatever stock, doesn't have to be SoFi, while you have collected premium and the stock came closer to your strike price, but it didn't hit your strike price. So actually with selling a put, the best feeling you ever get literally is when the stock slightly comes down and you're like, wow, I'm a genius. Everyone lost money, the stock went down. I am even closer now to buying it and I made money already. Amazing, right? If it goes below 26, you gotta buy it at 26. If it goes to 0, you gotta buy at 26. Obviously not 0, right? But no matter where it is, you have to buy at 26. And that's fine. If you determine ahead of time, this is where you wanna own the stock. So selling a put, 26, once assigned, you go into step number 2. You go into the second part of the wheel strategy. And once you're assigned, let's say that we got assigned at $27. You go into step 2. Let's say we have 100 shares right now. We start selling covered calls. So I go to sell call, and there's a few different strikes that you can pick. Let me touch on strike selection right now. If you go further out of the money, right? If you want to focus on income, go for a little bit higher on the delta. Here, the delta is really pretty high, but you're also going to make crazy amounts of money. Like literally what 280 is like 10%. Okay. So this is a 10% return in 1 month. That's amazing. You can see how your break even here is $30.91. But if you're bullish on the stock, you got assigned, but you want some upside and capital appreciation of the stock going up itself, you can also go higher. So for example, you can go for 30. You're going to make less money, of course, because the further the option is out of the money, the lower the premium is going to be. Here, the delta is also lower. So instead of 57, it's 45. It's still high delta, but it's lower. The volume here is massive, by the way. It's 9,000. So a lot of people are buying call options on SoFi. They're bullish, right? But look, if you sell 30, you're going to get less premium up front, which is less of that cushion, that less income, and then you get more upside because now you get a whole extra $1 of upside in terms of your break even. You're $2 higher in your strike price, you're lower on your premium, and your net difference here is a little over $1, okay? So you can make as much as $32 on this position because, yeah, 30 is your strike. If it goes up higher, you have to sell at 30 no matter what. You get $2 of premium. This is a great way to enter into stocks for cheaper prices. Again, it doesn't have to be SoFi. We have a lot of volatility in the market, by the way. And I just want to tell you that the wheel strategy is actually very good for volatility because when you sell put options and you sell them out of the money, you have cushion. So that's really nice. Let's go for American Airlines. This is actually a position I have expiring next week. I love American Airlines. Super consistent stock. It really just goes sideways a lot, which is actually really good. So American Airlines right now, it's at $12.82, and I just sold the $11 put. I have made really good money. And what's going to happen is once this option expires in the next few days, then essentially what I'm going to do is just sell another put option. So as part of the wheel strategy, if you don't get assigned, that's fine. You just get to sell another put option. If you do get assigned, just understand that getting assigned is part of the wheel strategy. It's not failure. It's a good thing to get assigned. You want to get assigned because once you get assigned, you go into the next phase of the wheel strategy, which is then selling covered calls. So never be upset with yourself. Just make sure that you absolutely love the stock that you're selling put options on.
So why SoFi is perfect for the wheel strategy? I really like the business fundamentals of SoFi. Like you can kind of see here, members are just growing at a very fast rate. If I zoom in here, new member additions, it's just compounded growth. Like you can see what compounding actually looks like from this chart alone. So since 2020, they had just a little bit over 1 million users. And now in 2025, they're already over 10 million users, right? This was from a quarter ago. So now they're over 10 million users. And this is great, right? It's a growing trend and they're gaining more users. So banking and financial industry is very strong, and I'm very bullish on the strong fundamentals that the business has. If you look at it, they have a fully digital bank with actual bank charter, so there's no need for physical branches, but they still have all the benefits. So they have engineered a way to make a lot of money with the financial side of things, but then also in a techie way, right? So their technology stack is amazing. Their engineers are very good, and they have multiple revenue streams, whether it's lending or banking and investing. They have lots of income coming in. And the main thing that I'm bullish on as a business model is their upsell model. So the upsell model is basically they have learned how to acquire customers at a very low cost. So their cost of acquisition, or CAC, is very low. So if they're able to get in a lot of people in the door, they're essentially using a strategy called blitz scaling, which is they're putting all their money at customer acquisition. But the good news is, unlike a lot of dumb Silicon Valley companies, SoFi isn't like that. They're a more mature business. So once they have low customer acquisition, they're also very good at converting these customers into more products. So that's what you want to see from a business is, are customers doing more business with this business? Are they coming in? For example, think about it at like a restaurant. If a customer comes in, they eat at a restaurant, are they going to come in again? Or, are they just a one and done? You don't want someone to be one and done. And SoFi is a perfect example of the latter, right? The customer comes in every single day and they're a regular, right? And then they, buy drinks and recommend their friends, and that's SoFi. That's where they're at. So SoFi has a lot of growth, great brand, and great business model, amongst other things as well. So yeah, it's perfect for option trading as well, because SoFi has high implied volatility. High implied volatility means that there's higher premiums. Higher premiums means that you collect more money. That's all it is. Now let's talk about how much money that you would need to actually make $10,000 a month, because I know that is the title of the video, and that's really important for you because that's the outcome that you want to achieve, right? The capital that you would need would be roughly $200,000 to $300,000. $10,000 a month is about 5% of $200,000. It's about 3.33% of $300,000. So that's the type of portfolio that you would need to make $10,000 a month. So I wouldn't say it's little, but it's also not that much. And many of my students that have $100,000, they have a really clear path to getting to this point of $200,000 to $300,000 in their accounts. So if you're targeting 3 to 5% monthly return, then you would eventually get there in a reasonable amount of time, especially if you can add some money along the way. You would need to learn option trading anyway. So this is like very viable for anyone to really get to within the next 5 years, even if you have a smaller portfolio. Like the minimum that I work with would be someone that has $25,000. So even that person, if they're adding money and compounding, can get to retirement within 10 years, which is a very good accomplishment. If you diversify across 8 to 12 stocks, you really need to do that because you can't just have SoFi. Of course, SoFi has to be like part of your portfolio, but not the entire amount. So I would recommend smart position sizing. I talk about that in many of my videos. And for example, it can be like 25,000. So if you have $250,000, you can put 25K into the position. I would say 10% max. But for some other stocks that I covered recent video on NVIDIA using the wheel strategy. You can check out on my channel. I talked about you can go heavier into that. Something like 20% is fine, right? So yeah, you want to target $800 to $1,200 a month from SoFi alone, but then repeat this strategy for other stocks, the ones that I cover specifically.
All right, guys, if you enjoyed that quick tutorial on SoFi stock and how you can make money using the wheel strategy, and you want to make bicep over tricep money, you really want to take it to the next level, you want to create income, then make sure to click that first link in the description. I am coaching and I'm showing you all the plays that I make to scale your portfolio. And during tough, volatile times, I'm going to be in your corner helping you throughout the journey of the market. So make sure to click that link in the description, and I'll catch you in the next one.